All right. So, hi, my name is Tara Kendrick, and I'm here with Bill Witt, and we are SRC or Senior Resource Center. And today we are going to show you Social Security changes that affect educators, public service workers, and just an overall view for your understanding of how Social Security works and how to maximize Social Security. So with our business, this isn't just the only thing we do. We also do comprehensive retirement planning, which part of that is Social Security planning. We do tax planning, and that's not tax prep. We just help people find ways to pay less tax. We do a lot of long-term care planning, and that includes helping people qualify and protect their assets using federal and state programs like Medicaid and VA aid and attendance. And then we also do estate planning, meaning we help make sure that you can avoid probate and that you have your legal house in order. So with that, I'm going to pass it over to Bill, and he's going to start our presentation to help you understand your Social Security.
Thanks, Tara. A challenge we face with all the families we try to help is the problem of longevity and risks. As a society, we're living a lot longer. If we were born 200 or 300 years ago, retirement planning probably wouldn't be a major issue. But because longevity has increased from about 1900, it was about 30 years. Now, if you're born today, you're going to live into your late 70s. So that's a substantial increase in longevity. And it means that the money we have that we've saved up has to last a lot longer in retirement. Another problem that we face is that many people, many of the clients, many of the families we help, one of the spouses has worked maybe as a teacher or in a public sector job where they have a government pension. And sadly, for many, many years, my wife is one of these people, their Social Security benefits are reduced in a number of ways. And we're going to talk about some new opportunities that have come about just recently, literally from the beginning of January. So for people that do have a reduced Social Security benefit, now you have some new opportunities. Today's topics, we'll give a quick overview on Social Security basics so everybody understands kind of how the system works and what benefits you're eligible for. We'll touch on windfall election provision, WEAP, and government pension offset, GPO. These are two ways that people with a government pension were hindered or hurt in reducing their benefits from Social Security. We'll explain how that took place. And then we'll talk about the Social Security Fairness Act that just came into being at the beginning of January and how it offsets or eliminates WEAP and GPO. And then lastly, we're going to walk through some specific opportunities. You're going to see that some of what you're going to receive if you are on a government pension and you get a step up, that may be good, but there may be other opportunities to increase your lifetime payout. So Social Security basics. Your benefit depends on several things. It depends on how much you earn during your working career. It's based on the age at which you apply for benefits, and then it's based on which benefits you claim. If you're married, you have up to 3 different benefits you can claim. You can claim individual, that's based on what you've earned over your work history. You can claim spousal. If you have a spouse that's on claim, you can claim half of their benefit. And if your spouse has passed away, you have a survivorship benefit that you can tap into. So we'll talk about all of these very quickly. So how is your individual benefit calculated? Well, it's based on your 35 highest years of earnings. It's called AIME, and this helps determine, they average your 35 years of earnings. Each year, the government sets a limit as to how much of your income is subject to Social Security tax. And if you max it over 35 years, you get the maximum benefit. They calculate the benefit based on 3 different bend points. Not going to spend a lot of time on this, but they use these to calculate your primary insurance amount. And that's the amount that you're eligible for when you hit a full retirement age. and I'll explain what that is. And then the third thing to know about your Social Security benefits increase each year based on cost of living. We've had some inflation the last couple of years, and so people's benefits have gone up nicely. So what is full retirement age? Well, each of us has a full retirement age. And for people born between 1943 and 54, I'm in that group, the full retirement age was 66 years. But you'll notice if you're born after that, that gradually the full retirement age is increasing. And then finally, people born in 1960 and later, for them, their full retirement age is 67. So how does claiming based on age, how does that affect your benefits? Well, let's say we've got somebody who has a full retirement age of 66. That's my category. I get 100% of my benefit if I claim at age 66. What if I claim early? Well, you'll notice that you start out at a lower percentage. In the case of someone who's 66, full retirement age, their age 62 benefit is 75% of what they would have gotten if they waited till age 66. What if your full retirement age is 67? Well, if you claim early, you start out at 70% if you claim at 62. And so you start with a smaller benefit. And as we'll see in a future chart, when you start with a smaller benefit, it stays smaller the rest of your life. What if you claim after full retirement age? Well, this is where some of the opportunity exists. People that wait beyond their full retirement age, they get an 8% roll up each of those years. If you're age 66 is your full retirement age, by waiting till age 70, yes, you delay getting checks, but you start out at 132% of the benefit, a much bigger number. And we'll have some case studies later that are going to show you just how impactful this can be over your lifetime. If you're age 67 full retirement age, by waiting those 3 additional years, once again, it's 8% times 3, you start out at a minimum of 124%. Now, we have a book we created back during the pandemic. Tara and I wrote a book on retirement planning, more money for retirement. In there, there's a very interesting chart, and it shows the impact of claiming age. So here I've got a chart showing somebody that claims at age 62, or possibly they wait till age 67, or they wait till age 70. And what these lines show is the cumulative lifetime payout from Social Security. You'll notice something interesting. The lines cross around age 78. So what this tells us is people that start early, they get more checks, but by age 78, everything is evened out. And so I usually ask the families we're working with, do you think either of you, husband or wife, are going to live past age 78? Usually the answer is, yeah, we'll probably live way past 78. Well, if you do, by delaying your benefits, you get a larger amount of money, more cumulative lifetime payout over your lifetime. And I've got some case studies that'll show you exactly how this works. Oftentimes people come in to talk to us and we're doing retirement planning and they go, hey, I'm thinking about claiming Social Security before my full retirement age. And I ask them a question, are you working? Yes, I am. Well, if you are working and in the years leading up to the year before you hit full retirement age, so let's say your full retirement age is 67. If you claim Social Security at 62, 63, 64, 65, any of those years, if you earn over $23,400 in 2025, for every $2 you earn above that amount, they take $1 away. The year before you hit full retirement age, the limit goes up much higher. It goes up to $62,160. And for those folks in that last year before full retirement age, if they earn more than $62,160, for every $3 they earn, $1 of Social Security benefit is withheld. Now, if you do claim early and you have a reduced benefit, your benefit is adjusted when you hit full retirement age. So you don't really lose all the money. It's just you have to wait till full retirement age to get an adjustment. To avoid the earnings test, the simple answer is always wait at least until your full retirement age or later to apply for benefits. Then there's no income offset. People ask us about taxation on benefits. And these are numbers that were created years ago, and they don't change. They're not indexed for inflation. So when Social Security was originally created back in the 1930s, it was tax-free income. But in 1983, President Reagan, in order to try to shore up and keep Social Security solvent, he instituted the first tax on Social Security benefits. And at that time, up to 50% of your Social Security benefit was subject to taxation. President Clinton went a step further in 1993. He allowed or signed legislation that allows up to 85% of your Social Security benefit to be subject to tax, not an 85% rate, but at whatever tax bracket you're in. And where this is problematic, they do a provisional income calculation to determine if your Social Security is taxable. They take your other adjusted gross income, add 1/2 of your Social Security benefit, plus any tax-exempt interest you earn. And if you're married and that number is over $32,000, well, up to 50% of your benefit, of Social Security benefit, is subject to tax. What if it's over 44,000? You're married filing jointly and it's over 44,000, then up to 85% of your Social Security benefit is subject to tax. Why this is a problem is these numbers haven't changed in years. And, as other things have been indexed for a cost of inflation, and the more income today, people earn a lot more money, more and more people are falling into the category of being taxed. So this is something people need to know. They think, well, I'll claim my Social Security, I'll have all this wonderful money to spend, but maybe a good portion of it is going to be subject to tax and paid to Uncle Sam. So earlier we talked about you have 3 different benefits you can claim. And so let's walk through these very quickly. The first is individual. That's based on your work history. They take your 35 highest years of earnings and determine what your payout amount is going to be. For people that are married or divorced, if the marriage lasted more than 10 years, they have the opportunity to claim 2 other benefits. And one of them is spousal. What is spousal? Spousal is half of your spouse's full retirement age benefit. So if you're married to someone and they are on claim, you can claim half of their full retirement age benefit. You have to claim at your full retirement age to get all of the benefit. Once again, claim early, you get a reduced benefit. And then what is survivorship? Well, in a marital situation or even a divorced situation where you've been married for 10 years and then divorced, if your former spouse or if your spouse passes away, normally the surviving spouse steps up to the higher of the 2 benefits. So if you're married to someone who had a higher earnings rate, and maybe you were serving in as a teacher and earning a nice TRS pension in Texas, but where your Social Security benefit was curtailed, we're going to show you how to increase the survivor benefit. So let's talk about the 2 factors that reduce benefits. We talked about windfall election provision, WEEP, and government pension offset. WEEP applies to your individual benefit. And I'm going to show you an example of this. In fact, it's based on what my wife is receiving as a retired teacher. So WEEP, it reduces your individual benefit. What about if my wife wanted to claim spousal or survivorship? Well, then another form of reduction comes into play. It's called GPO, or government pension offset. And what they do is they take 2/3 of your government pension and subtract it from either the spousal benefit you were eligible for or the survivor benefit. And it has a substantial reduction on the Social Security benefits in the past that you were able to receive. Unfortunately, this has all changed, and it's going to be beneficial for many, many people that have had reductions in their Social Security benefits. On January 6th of this year, President Biden signed the Social Security Fairness Act. And this act eliminated the WEEP and the GPO reductions. And And what it means is that your benefits are now going to be recalculated by Social Security. And the good news of this act, it's not just going to take effect starting January of this year, but they're actually going to pay the higher benefits you were eligible for going back to January of 2024. So most people will see a lump sum payment, and then they'll see a higher monthly benefit being paid out. But there's some opportunities here that you need to know about. And the real question is, will Social Security consider spousal or survivorship opportunities if you're claiming on an individual basis? The answer is probably not. Well, let's take a look at this. We're going to talk about 3 different ways that you may be able to get not only more money based on the Social Security Fairness Act, but there may be additional opportunities to step up to a higher Social Security benefit. Let's talk about these 3. One is switching from individual to spousal. A second is switching from individual to survivor. And the third is delaying your benefits until age 70. So let's look at the first one, individual to spousal. My wife is a good example. She has enough work history, in addition to her TRS pension, that she was eligible for about $900 a month in Social Security benefits at her full retirement age. But they didn't pay her $900 because of WEAP. They reduced it down to about $250. And so she was getting her TRS pension, but she lost out on a good chunk of her Social Security benefit. Now, my spousal benefit at full retirement age was around $2,800. So she was eligible. If it wasn't for the WEAP and the GPO, she'd have been eligible for half of my full retirement age benefit. She could have gone from $900 up to $1,400. But because of the GPO, they took 2/3 of her government pension, about $2,000, subtracted it from what she was eligible for, and she didn't get any of it. So she claimed her individual benefit, and they were paying her $250. What we expect to happen is in the next month or 2, Social Security is going to recalculate her benefit. They're going to offer her this increase up to $900. That's wonderful. The question is, will Social Security also go, hey, my wife is eligible for a spousal benefit. She's actually eligible for a higher amount. Social Security probably isn't going to make this offer to get the higher amount. I mean, getting $900 is better than $250, but wouldn't it be nice to get $1,400? And the way she has to do that is by trekking to a Social Security office and say, hey, I'd like to now claim my spousal benefit. So part of this is automatic. Getting the $900 is automatic. Getting the rest of it probably isn't automatic. It's going to require that she and I make a trip to a Social Security office and claim spousal.
Well, and also this is for people who had 40 quarters and they were eligible for Social Security, and they also worked in an environment that didn't contribute to Social Security, like a government job or a teacher.
Right.
So she had her 40 quarters, so she was eligible for Social Security, and she has a teacher retirement.
Right. And the school system, the Lakeway school system she taught in, didn't contribute to Social Security. That's why she had the WEAP and the GPO offsets.
Okay.
All right. So first one is, it'd be nice to get $900, but I think my wife would rather have $1,400 each month to spend. And so we're going to trek to a Social Security office after she gets her lump sum and starts receiving the $900. It's time to make a trek to Social Security and request spousal. What if I had passed away from the time she made an individual claim? She's claiming individual. Why? Because it didn't make sense to claim spousal. And in this case, it didn't make sense to claim survivorship. I was alive, so she didn't claim survivorship. But look at the difference. Had she claimed survivor, it's less than the $900 she'd be eligible for. So people that are on individual and their spouse has passed away, now she'd be eligible for my full $2,800 benefit. But I don't think they're going to pay that. They're going to pay the $900. Once again, if you've lost your spouse since the time you claimed individual benefits, it's probably time to make a trek to the Social Security office and say, thank you for the higher 900, but gee, I'd like to get my survivorship benefit, which is much higher. This is another, it's going to be a two-step process. Wait till Social Security grants the 900 or the individual benefit, get your lump sum, and then make a visit to a Social Security office to claim the higher benefit.
And we don't know when they're gonna get, it's probably gonna be about a year, right? Before
Well,
they're saying up to a year.
my wife, as soon as she heard President Biden sign this act, she was ready for the check to show up. And Social Security announced a couple of weeks later that it's going to take them a while to recalculate all of these benefits. So it probably will be later this year.
Right.
It isn't, but when you get your benefit individual, probably time to make a trek to a Social Security office to claim your other opportunities.
Yeah.
So let's talk about a third opportunity that plays into this. We
And
talked
this is
about
for anybody.
this is for anybody.
Yeah.
But I want to show you an example, two examples, a single person and a married couple, and talk about ways that they can increase their lifetime payout from Social Security. Remember I said that the benefits step up 8% a year. So if we have a single person whose full retirement age benefit is 900, if they wait till age 70 to claim, they start out at $1,116, a much higher amount. If you're married and the primary spouse waits till age 70, that 2,800 increases to 3,472, which is what I did. I waited till age 70 to claim my benefit. I wanted to start out with a higher number that will grow faster than had I started out with a lower number. And if I pass, I leave that much higher survivorship benefit to my surviving wife. So let's take a look at a couple of examples of this. The first one's a case study, and we've got Susan. She's a single lady, never married. She's 62. Her full retirement age is 67. She has a government pension, and her full retirement age benefit under Social Security is 900. Let's look at three different dates when Susan could claim her benefit. 62, wait till 67, or wait till age 70. What this chart shows, this is some of the software we use for analyzing the lifetime payout for our clients so they can make informed decisions knowing how to maximize their benefits. So the top one, it shows the income that's being paid out at various ages, starting at age 70 up to age 90. And the far right column shows the cumulative benefits that have been paid out since going on claim. Well, you notice if you start at age 62, that initially the benefits, the cumulative benefits are higher than waiting until age 67 or age 70. But over time, by delaying the benefits, not only is the annual income going up, but so is the cumulative lifetime benefits. And in this case, assuming Susan makes it to age 90, if we compare her age 62 income, or if she claimed at 62, what the income would be at age 90, she'd be receiving $13,162 a year. By waiting till 70, it's almost doubled. It's up to $23,316. So she's getting an extra $10,000 each year. Think about it. As we get older, wouldn't it be nice to have more income to spend as we get older? What about cumulative lifetime benefits? Well, they've increased dramatically. In the age 62 scenario, she would have been paid $293,000 over her lifetime. By delaying till age 70, she's getting an extra $100,000. She's up to over $404,000. That's a significant amount of additional money to receive over your lifetime. What about a couple situation? And we'll pick on Roy and Susan. They're both 62. Their full retirement age is 67, and Roy's benefit is $2,800 at full retirement age. Susan's is $900. We assume Roy's going to live to 84, and that Susan's going to make it to age 90. Let's take a look and see how the different scenarios play out. Once again, I've got them both claiming at 62. I have them claiming at 67. Or under the third scenario, I have Susan claiming her benefit at 67 and then waiting until Roy goes on claim at age 70. And at that point, she steps up to her higher spousal benefit. She switches from spousal to from her own benefit to spousal. And then when Roy passes away, she's going to step up to Roy's benefit. So let's look at the numbers. We've got 3 different scenarios. By waiting, and this is really significant, by waiting, Susan's income at age 85, remember Roy passed away at 84, her income is increased from $37,000 from Social Security annually to over $65,000 a year. That's a big, big increase. What about the cumulative lifetime payout? Well, it's gone up from 1.1 million if they had both claimed at age 62 to at age 90, it's over 1.6 million. They've increased their lifetime payout by over $500,000. A lot of money. So these are the kinds of strategies we work with every day, trying to help our clients have more income. Our practice is based around income more than asset growth. We want our assets for our clients to grow, but we want them to have enough cumulative income in retirement that's guaranteed, that supports their lifestyle, independent of what the stock market does or independent of what the Federal Reserve does with interest rates. So what can Social Security do? Well, they can estimate your individual benefits. They can calculate the amount you're entitled to today or now. They can't project future benefits and do scenario planning. They don't strategize to help you maximize benefits. If you go in and say, I want to claim my benefit at age 62, they aren't going to talk to you about what it would mean to you if you waited on your benefits to get a higher lifetime payout. They will just sign you up. Nothing wrong with that, but they're very good administratively. The problem is sometimes people make decisions if they haven't been educated on all their choices so they can make an informed decision. So here's what we offer to our clients. We do custom Social Security maximization analysis for our individual clients. Everybody's situation is different and unique. We have some very powerful software where we can compare scenarios. We don't tell people when to claim. We tell people what the impact of different claiming strategies would be on their lifetime payout. And then they make an informed decision of when and if to claim. So if this is something that's of interest to you, we offer this as part of our service. We do have a fee for doing it. We charge $500 to help people make an informed decision. But if you can raise your lifetime payout by $100,000 or more, paying $500 might be a very good investment. And we like to think of income planning for our clients as it's a multi-piece process. People they want to maximize their Social Security benefits. They may have pensions. Most people today have 403Bs, 457s, IRAs, 401Ks. At age 73, everyone's going to have to start taking required minimum distributions. And we have strategies within our practice to actually increase the amount of money that people get from their qualified retirement plans. We show people how to use a portion of their qualified funds to generate additional income, and it supports and pays out what's more than the required minimum distributions. And what you find out is eventually the income you receive can become tax-free. And we show people how to do this in our practice. And once again, income planning involves other categories. And you might have an investment portfolio. You might continue to work, which I'm doing. I'm over my full retirement age, and yet I'm still happily working and earning some income. Our goal in working with families is we want everyone to be cash positive in retirement. If you're cash positive, you don't worry about what the stock market's doing. You just are happy that you can continue to pay your bills and live comfortably. So Tara, why don't you tell our listeners about SRC University?
Sure. Yeah, so we started SRC University a couple years ago, And it's a great way for people to get educated on all things retirement. So they're 30-minute sessions, they're webinars you can listen to. They're available at your schedule. All you do is sign up for SRC University. You have access to the entire library of all of our topics. A lot of our topics are in our book, which we just had the new 2025 version come out. And so if you're interested in that, you can shoot us an email or give us a call and we can get you one of those. And, you know, our ultimate goal is to help you create a safe, secure retirement. We want you to feel good in retirement. And the good thing about our school is there is no final exam.
And SRC University is free. All the topics are there. You can listen to them at your leisure. You can listen to them multiple times if you want to know how different pieces of retirement planning work.
Yeah. So what I'd like to do is open it up to everyone. If you have any questions, please just feel free to shout out, you know, open your microphone and you can, we can answer any questions that you have. So does anybody have any questions? And if not, what you can do is if you have individual questions, what you can do is you can just give us a call. There's our phone number on the screen, or you can shoot us an email. We're happy to talk. If you'd like a free book, give us a call as well, and we can send you a book in the mail. So with that, we will have this recording up in about 48 hours on our website under SRC University webinars. So if you want to listen to this again, or if you'd like to send it to a friend or family, it will be available. So with that, thank you so much. Yeah.
Do you have any idea when Social Security will formulate the new monies for teachers?
No, we don't know. They have said it won't be right away, but they haven't given an actual date.
Okay.
Yeah.
Hopefully it's soon. My wife is ready to go shopping.
Yeah.
Hey, Tara, Bill, this is Lawrence Williams with Ann.
Sure.
My wife, we're sitting here. Hi. Thank you all for all your help. This has been a great presentation for us, very informative. You know, Ann is a teacher and under the same kind of situation as Bill as your wife. So we're looking at each other and we'll call you to plan one of those $500 sit-down sessions in the near future.
Okay, great. Well, happy to help you.
Thanks.
Anybody else?
Don't be shy.
All right, with that, we'll say goodbye and we hope you all have a wonderful day.